Okay, welcome to this week's Money Corner. Last week we talked about the rule of 72, which if you need a recap, go back and watch the other episode. Talked about rule of 72, which means how long does it take for your money to double. In this particular Money Corner, I'm going to give you guys a personal look into my real life. All right, I don't do this very often. I don't show this, at least not to the public, but we do this behind closed doors. I'm gonna give you a real peek into my real life. I'm gonna show you how I use a a debt pay down method called velocity banking, or my version of velocity banking is called pursuit banking. And pursuit banking is specifically used to pay down debt, just like the Rule of 72. As simple as I can explain it is, how long will it take for your money to double? In that example with the Rule 72, I said specifically, this could work in your favor. In other words, if you know how interest works, then you earn it. If you don't know how interest works, then you pay for it. So this could work in your favor, and it could also work against you, i.e., debt, i.e., credit card loans and payments. So if you don't know how interest works, it can work against you. If you do know how it works, it can work in your favor. I'm going to show you how. I'm going to give you practical steps how it can work in your favor. Because I know there's somebody watching right now and says, "Well, give us some examples. How is this going to work?" I'm going to give you guys a peek into my real life. I'm going to show you guys behind the scenes how I use a principle or a concept called velocity banking to pay down $21,000 in just 1 year. So my question to you is, how long will it take for you to save up $21,000? Some people could take years. It could take a long, much more. It could take decades for some people to do that. How about 1 year? How does that sound? So let me give you the scenario. Here's an example of where you use all where these concepts combine. These principles. This is why financial literacy and financial education is so important, because what I do is not what you do. What you do is not what I do. It's very relative to your life. But if you never heard of these concepts, never heard these principles, then you're not using anything at all. But when you utilize these concepts, you can apply it to your real life. And how I do it in my life probably won't be how you do it. However, if you just know about the concept, then you could use it to apply it to your real life. Because the truth is, you don't tell everybody everything, do you? You don't tell everybody all your business. You only tell them a little bit of a little bit. So I'm going to show you guys. Here's the scenario. So I bought a used car. Well, I'll give you a little bit of background information. I bought my first car in 2000, about 15 years ago, 2010, a brand new car. And as you know, Tiger, the worst investment you can ever make is a brand new vehicle. Am I right? Am I right? The worst thing you could ever do is purchase and finance a brand new car. That's the worst possible investment you can ever make. So what did I do? I went out and I purchased a brand new vehicle because I didn't know. No one had ever told me this before. All I knew was I needed a car. I was fresh out of college and or grad school, and I needed a vehicle to get to work. I could either borrow a car, and that was only temporary, and I could borrow money from my parents who they didn't have the money at the time, or from a family member. I couldn't borrow anything, so I had to go and finance a car. How many of you guys are in that situation? You probably have a current car note that you're paying right now. So you find yourself in a situation, and soon enough, you find yourself in a situation where you probably are struggling to afford that car payment. So what do? Well, you do like most people who are, may not be educated in these concepts. You go back to the dealership and you try to turn the car back in, or you try to get a new car for a lower price. Problem is, you can't get a car for a lower price, can you? No, you can trade in the car, but you're going to have to get another car for a higher price in order to absorb the car's value. and the money that you owe on the vehicle. Am I right? I know I'm talking to somebody right now because this is a true story, and I know this happens to a lot of people. This is what happened to me. Not only did this happen to me once, but this happened to me 3 times. I actually starting in 2010, I got a new car like every 2 or 3 years. And some people might say, well, you shouldn't get a car that you can't afford. Well, here's the reality, and here's what my response to that. What's the alternative? The alternative is to either take public transit, which is not realistic all the time. You probably live too far from where you work, or your circumstances prevent you from doing that. But nonetheless, you find yourself in a situation where 3 cars later, or 4 cars, or 5 or 6 vehicles, whatever it is, you each subsequent car has absorbed the previous car loan. So I finally got to a point where I was financially educated enough to know that a new car is a terrible investment. And at that point is when I finally found a vehicle that was not new, but it was within a a manageable range for my situation. Now, here's what I did. I'm gonna tell you guys. The car was worth a certain amount. Let's say it was worth 25,000. So, you always hear people say, put zero down, right? Put zero, no money down, and then you walk away with 0% for the next 12 months. Well, what does that really mean? If you've never actually gone through that, could you actually walk someone, a family member, a loved one, or a son or a brother through that experience? I'm gonna show you. Here's what I did. I understood what those principles meant. You put down, so let's say in this example, I got a car at 25,000. I put 5,000 down, and then that dropped the value down to, or what I owed on the car. I put 4,000, and then I dropped the value down to $21,000. So here's what I did. Here's the move right here. Once the car was worth $21,000, or something that was more manageable, check it out. Again, this is where we know how the rule of 72 works in your favor if you know it, and it works against you if you don't know it. Me knowing, and you now, you know the rule of 72. Here's what I did. Capital One offered me a 0% balance transfer for 12 months. And I'm going to show you this right now. I'm going to pull up my screen. They offered me a 0% balance transfer for 12 months. Once the balance of the vehicle was within the balance, or could absorb the balance of the credit card, I swiped, I swiped it so fast. I didn't know what happened. I might have started a tornado in the Midwest. That's how quickly I swiped the card, and I paid off the entire car right there, right then and there. You're probably thinking, why would you pay for a car on a credit card? Here's the reason why. The car was at 6% interest, and it would have taken me another 4 years to pay off the car. But by me swiping the card at 0% for 12 months, I paid off the car in 12 months. Check it out. I'm gonna share my screen. I'm gonna show you guys exactly uh, what this looks like. Okay, I'm gonna sign in here. I'm gonna show you guys. Over the last calendar year, since last August, says no more transactions are being able to show. This is my real life right here. And I'm going to show this tab here where you see from the date here, which is last July, and then that coincides, well, this is August here. You see the amount, 3607. And then you see August here, you see the amount, 3607. And then the next month is 3,000. The next month after that is 3,000. And then you see the next month after here is 3,000. The next month is 3,000. And then November, and then December, and then January, and then February, $1,000 each. And then November, and then December, 2,000. And then from January on, $1,000 each. So that after an entire year, after 12 months, there'll be a 0%, zero balance on this card. This is basically the car payment. This is how you pay off an exact, again, using the rule 72. If you use a rule 72, how many times if you have an interest rate of 0%, how many times does that go into 72 times, right? Zero times. That's right. Zero times. So that means your principal 100% goes to the balance. Once you swipe the card, and once you have a remaining balance on the card, now it's up to you to divide it however you want, and in order to fit into that period of time. How long is it going to take for you to to save up $21,000? Could take years, could take decades. But if you understand how credit works, you understand how interest rates work, then the debt that you create could actually work in your favor. Now all of a sudden, you own a vehicle outright. Now all of a sudden, credit card companies are seeing that you're using credit the way it's supposed to be used. So then they offer you, additional credit. Now all of a sudden, you're under less stress and under less financial angst because the definition of out of control debt is debt that does not have a payoff date. As you can see, as you can see, I gave the debt a payoff date, which was this July. So I'm happy to report that after this July, I will be the owner of a vehicle, right? No more car payments. I'm team no car payment, hashtag no car payment. And at the same time, I now have all of this available credit to use. The other concept I want to say briefly is when you use the concept of velocity banking, this concept also provides that your credit card is the checking account. That means your available balance becomes your checking account. That means all of your expenses, all of your bills gets paid through the credit card. So even your monthly car note is paid with the credit card, not from your checking account. If this is making sense to you, then welcome to the Velocity Banking in the Money Corner family. I will go over this topic in much, much great detail in future videos. If this doesn't make sense to you, then leave a comment below. Don't be afraid. This is something that I learned and I had to go through it in order for me to actually apply it. I heard so many concepts about people paying off mortgages, 30-year mortgages in 7 years, 5 years, 8 years. And I wondered, how is that possible? Well, it is possible. If that concept works with a mortgage, a 30-year mortgage, then how come it can't work with a 4-year car loan? Well, the truth is that it can. It actually can, because debt is just debt, no matter if it's credit card debt, if it's a mortgage debt, if it's student loan debt, or debt is just debt. Uncontrollable debt or out of control debt is debt that does not have a payoff date. Control debt that's under control is the debt that has a payoff date that you give it. So therefore, it's more manageable and you are under less financial stress. So if you want to learn more about this concept of velocity banking, pursuit banking, how to control debt, how to manage debt, and how to take more control of your life so that you can get more access to credit, you can get more higher offerings from credit card companies, then please feel free to leave a comment below. And then also scan the QR code and you can schedule a one-on-one appointment with me, 15 minutes. We'll bounce some ideas off each other's head and I'll offer some solutions. That concludes today's Money Corner.
Dirty engineer boy. Circle.
Okay, we have some question about the money corner there, Tech. Well, hold on one second. Opera Brother said, why use credit cards as a checking account to earn points?
Great question. And the answer is yes. That's one of the, I could probably name, well, I'm not going to say how many. I can probably name countless reasons why you should use a credit card over a checking account. But number one, the points and the rewards, I don't even use the points and rewards. I use the points and rewards as credit to pay towards the balance. But like, for example, my wife, she uses the points and rewards for other purchases and credits towards, you know, like other rewards and other gifts. I just use statement credit. Boom, statement credit, statement credit. That's one of the reasons. The other reason, here's another reason why, but this is the biggest reason, Opera Brother. And I'll ask you, you don't have to answer this, but just think about this. How much money do you have in your checking account sitting there right now? Let's just say round number, $1,000. Let's say you have $1,000 sitting in your checking account right now, this very moment. What is that money technically doing right now? It's technically, it's at best, it's probably earning 0.01%. At best, maybe 0.02%, right? Now, in contrast, how much is the lowest credit card that you have? I'm not even going to go with the highest because that would just be too easy. But let's say you have a credit card with a limit of $2,000. So on one hand, you have a checking account with $1,000 sitting in there doing nothing, maybe gaining 1% or 0.1%, a tenth of a percent, and then you have a credit card with a limit of $2,000. Okay, the $2,000 credit card limit is actually more, correct? You understand that? When you pay for bills, items, you pay for groceries, you pay for utilities, you pay your mortgage, you pay your rent, pay your car. When you pay for things from your checking account, let's say you pay for a $200 internet bill from your checking account, that $1,000 instantly drops to $800. Am I right? That money's gone. It ain't never coming back. It's gone. That money's been transferred from your checking account into the abyss, or at least to your internet company. If you take that same transaction, because you're going to pay it anyway, weren't you? You're going to pay that bill anyway, but pay it from your credit card with the $2,000 credit limit. Now you've got an $1,800 credit card limit, right? Now the $200 that was subtracted from your checking account is gone forever, but from the credit card, that money it returns, it goes back. You can reuse that money again. You can use that $200 again when that credit card gets paid, can't you? So then the limit goes back up to 200. It regenerates itself. It refills itself. So that's one of the primary reasons why we use a credit card over a checking account. Here's another reason why. So much talk is about building an emergency fund, and I'm a big proponent of having an emergency fund. 3 to 6 months is typically what's recommended. Probably need about 6 to 12 months in real, especially now with AI coming around, AI taking people's jobs. It's gonna be mass layoffs coming around. I don't know if you know that or not, but here's the thing: if you have a $15,000 limit on your credit card, or some people have higher limits than that, you can see I absorbed the whole car of mine. That you can use that money's that's yours. You can use that. I'm not saying go out and go to Disneyland and go buy a boat and some jet skis and just spend the whole thing. But I'm saying that whole concept of an emergency fund, instead of having that sitting in some account, some savings account somewhere doing nothing, maybe it's gaining a modest 2%, 3%, maybe. But as you know, inflation is already at about 6, 7%. So you're not really doing anything. And you have to pay taxes on that money that is so we're kind of getting I'm kind of getting a sidebar here a little bit, but what I'm saying is by storing money into an account, a savings account, checking account, That's not the purpose of a savings account or checking account. The purpose of a savings account or checking account is to transact money, is to move money. It's not for it to be stored there, to sit there. Money should be stored in either investment accounts where they're gaining more interest, or at least more than inflation is, and then, or in a line of credit. In a line of credit, you can store money in a line of credit where not only are you eliminating interest, like we talking about the rule of 72, you're neutralizing the interest. So the money is actually paying for itself, and you have a greater access to a limit or to a higher balance because you're going to pay your credit card, you're going to pay your debts anyway. And on top of it, not to mention the rewards, like you said, and then the perks and all the points and all that stuff that comes with it. And then you also have a record of that transaction. So if something were to happen, you can also get it back. So there's just so many advantages to using a credit card as your checking account than actually using a checking account. A checking account purpose is just to transact money. It's not meant to store money. I don't know if you guys knew that or not, but that's an excellent question, Aqua brother. I hope I answered it.
Yeah, Natural Jesse says essentially to earn points, use as leverage to increase your credit limit and improve your score. Yeah, it's a triple bubble or even more.
Yeah, and those I didn't even mention those. I
Yeah.
didn't even mention those.
She asks, will a template be available for the worksheet?
But I would say schedule a sit down where we can, where we can actually discuss that, and then I mean that's nothing but a link. We can definitely make it available to you.
Yeah. Yeah, we see you guys are enjoying the Money Corner. We're going to continue to bring this heat. Tech is certified and licensed to talk about this stuff, and I appreciate this segment on the show.